This is not financial advice. I'm recording my thoughts about Mercado Libre Inc. It operates the e-commerce platform in Latin America. The stock is currently trading at about $1,161 with a market cap of about $58 billion. In this video, I'm going to cover Mercado Libre's business model, financials, and finally I'll do a valuation to determine if this is a good price to enter the stock or not. Let's first look at their business model. As you can see on the screen, they have about 5 different revenue segments. One thing that is not shown on here is the Mercado credit, but we will go over it when we go into the financials. Mercado Libre operates the marketplace where you can buy and sell things, and they also cover the advertisements. We have a SaaS platform, which is Mercado Shops, and then there is a fintech wing, which is Mercado Pago, and then they have shipping or logistics solutions in the form of Mercado Envios. And what's not shown on here is the Mercado Credito, which operates the credit facility for this company. Let's now move on to the financials. Let's look at its latest quarter performance. As you can see on the screen, they made about $3 billion of revenue, which represents 58.4% year-on-year revenue growth, but that is Forex neutral. Since this company operates in Latin America, there are risks associated with exchange rates from US dollar. So as an investor, I would be interested in knowing the growth rate in USD. That's about 35%. So that's almost 23% less. So we can understand how much this exchange rate is going to affect this business. Also, you can see the operating income is about $340 million. So that's about 11.2% operating margin, which is healthy. At $1,161 stock price, the market cap is about $58 billion. For the past 12 months, they made about $11 billion of revenue. That's a price to sales of just over 5, which is not bad. And the net income is about $618 million, but this also includes some interest income. So show more details when we go over the financial statements. The PE ratio is about 100, which is expensive, and the forward PE is 61, which is also on the expensive side. But when a company grows faster, the PE catches up quick. So when we look at the valuation, we will see whether it is worth paying this PE of 100 at this price or not. Mercado Libre has over 100 million active users, and their fintech business handled a total payment volume of about $37 billion, which is very impressive. And they also operate a credit facility, Mercado Credito, that's the revenue segment. And the credit portfolio grew marginally to about $3 billion. And I actually like the fact that they're taking a cautious approach to originations because we're in a very difficult macroeconomic environment. Like I said before, in the most recent quarter, they made about $3 billion of revenue, but almost half of it, $1.6 billion, is coming from the marketplace. That's the Mercado Libre itself. And the gross profit is about 50.6%, which is healthy. And the operating margin, like I said, is about 11.2%. The net income in the most recent quarter was close to 6%, but it also includes the interest income. And we'll go over those financials shortly. Looking at the revenue split in a bit more detail, as you can see on the screen, I put a purple box for the Q1 2023 revenue split. Out of the $3 billion of revenue, almost $1.676 billion came from the commerce business, and $812 million came from the fintech services. So that's about 30%, close to 30% of the total revenue. And credit revenues are about $530 million. That's about 18%. And the total fintech revenues represented $1.3 billion, so that's about 45% of the total revenue. Let's dig deep into the most recent quarter performance. As you can see on the screen, the total net revenues are about $3 billion. The gross profit, as I mentioned before, is about 50%, putting it at $1.5 billion. The operating expenses, as I show on the screen, are about $1.196 billion. So the operating income is positive, $340 million. So this company is profitable. After this operating profit of $340 million, they managed to make about $201 million of net income. That's almost 6% of the total revenue, $3 billion. But you see one line item here, interest income and other financial gains. That's about $161 million. If that $161 million of interest income wasn't there, the net income would have been much lower than 6%, but it's still money. And that net interest income is coming from the cash that they have on their balance sheet of close to $6 billion. Mercado Libre has a very healthy balance sheet, a lot of cash on their balance sheet, which is good enough for them to run the operations for years to come because they're already profitable. Let's now move on to the most interesting part, that is the valuation. As usual, I'm going to show two cases, one with reasonable assumptions and the other one with great execution. In the reasonable assumptions case, as you can see on the screen, in 2022, they made about $10.5 billion of revenue. In the most recent quarter, if you consider the Forex, they grew their revenue by about 35%. And as we know, when the company grows bigger and bigger, it's hard for them to grow. And there is tremendous amount of competition in Latin America's e-commerce. For example, Amazon is investing heavy into Brazil, for example, where Meli operates. In my opinion, with all these factors, 25% estimated growth rate is reasonable. With that, they can make about $32 billion of revenue in 2027. That's almost tripling their revenue, right? Currently, they're at $10.5 billion and they're tripling their revenue to about $32 billion. I think that's reasonable. E-commerce and fintech are typically low margin businesses. We know their gross margin is in the order of 50% and operating margin is about 11%. For example, Amazon's e-commerce business in the US is making less than 10% net profit margin. So we can understand how difficult it is to make double-digit profit in the e-commerce or the fintech sector. So I'm assuming 10%, which I think is very hard to do. The current net profit margin is about 6%, even when you consider the net interest income, right? So with 10% net profit margin, which is hard to do, they would make about $3.2 billion of net income in 2027. For a company that's growing in the 25% range and has a 10% net profit margin, I can comfortably pay a multiple of 17.5. But I'm going to be generous because Meli has significant presence in the Latin America, so I have to pay a premium for that. And it's already profitable too, right? So I'm going to have a premium multiple of 22.5, with which this company would be worth about $72 billion in 2027. With respect to number of outstanding shares, currently they have about 51 million outstanding shares. And as you can see on the screen, they did dilute the shareholders, not too significantly, about 2% year over year when I consider the past 5 years. They have a lot of cash, almost $6 billion on their balance sheet, but they have authorization to get till 110 million outstanding shares. So I'm assuming that they're going to dilute a little bit, like 2% year over year. With that, they will have about 56 million outstanding shares in 2027, from 51 million to 56 million outstanding shares. When I divide the 72 billion market cap with 56 million outstanding shares, I get a stock price of about $1,280. Currently, they're at $1,169, right? That represents about 10% gain in 5 years, which is going to lag the index significantly. So 10% is not at all good. Now let me show you the valuation with great execution. Assuming an estimated growth rate of 35% year over year, which is very hard to do considering their recent performance. But since this is a great execution case, I'm going to keep it at 35%. With that, they will more than quadruple their revenue to about $47 billion in 2027. I cannot give a net profit more than 10%, even in the great execution case, understanding the e-commerce business and fintech wings. So with 10% net profit margin, they will have about $4.7 billion of net income. And I'm going to apply a 27.5 multiple, which is again a premium multiple for this company. With that, they would be worth about $129 billion in 2027. And since this is a great execution case, I'm assuming zero dilution. They currently have 51 million outstanding shares, and 5 years out, they will still have 51 million outstanding shares because they have a lot of cash on their balance sheet. They have no reason to dilute the shareholders. So that's why I'm keeping 51 million outstanding shares. With that, the stock price would be about $2,539 in 2027. Currently, they're at $1,169, right? That's about 117% gain in 5 years, which is very attractive. For my personal journey, I'm going to consider the valuation with reasonable assumptions where I'm seeing only 10% growth. So I'm not interested in investing in Meli at $1,169. I will at least wait for it to fall to about $800 so that I can at least expect a 50% gain in 5 years to at least have performance on par with the index. If the stock price does not get to $850 or so, I will stay on the sidelines. But having said that, I'm going to follow this company's financials in the next few quarters. Maybe they will accelerate their revenue growth, right? So that gives me a reason to buy the stock even at a higher price. So if anything changes in the next quarter, I'm going to do another video with the revised valuation. But for now, I'm staying far away from Meli. Let me know your thoughts in the comments. Thank you so much for watching.